Wait.
Hi, Bob.
Hey, Cornelia, hold on.
Hi, Christine.
How are you?
Good. How are you?
Pretty good. Hanging
Did you have
in
a
there.
good, did you have a good weekend?
Yeah. Yeah. It's like, I'm so like ready for it to be over.
Yeah, I agree.
Right. Well, you're taking, how many classes are you taking?
Oh, just another one, which is the finance one, but so just two.
Oh,
I know
I'm
that
like,
was really dumb.
well, I don't, it's like, I just feel so old. Oh my God.
It's been hard. It's been a hard curve for me to remember how to use my brain.
Me too. It's been good. Like, I like it. And I signed up for the next one. Like, I'm like, what am I doing?
Nice. Good for you.
Yeah. But so are you, what's your major?
Oh, I don't really have one. I'm trying to figure that out, but I'm just taking all the classes I didn't take back in my college days. So I'm usually in a creative field, so now I'm just taking everything that's been the opposite.
Wow.
So we'll
That's
see.
awesome. That's
Yeah.
totally cool.
I was hoping, are we doing the review today? Because I really don't know where we're at in terms of.
I don't either, and that's why Cornelia is going to join us in a few seconds.
Oh, wow.
Oh, awesome.
Yeah. We're going to go over chapters 8 and 9. And we also are done with the semester this week, as you should know, right?
Yep.
Mm-hmm.
So buried in the syllabus was a big test due tomorrow, I think. So from what we were just saying, we'll push the test back a day or so. And then there's a final exam after that, I believe. And that's what we're going to clear up right now. Because if I go through chapters 8 and 9, I want you to at least take a test with it, Hey, Patty, how you doing, man?
Doing good.
We have a special guest joining us today. Hi, Cornelia. Cornelia is mute.
Yes. Hi, everyone. So Bob was a bit, Bob had a question. Hey, I'm
Herbie,
in
how you doing, man?
Good. So Bob had a question about the exam. So there is an, and I was trying to load the syllabus. So there is an exam about the last few chapters through chapter 15.
Zooming in 2021.
So that's Zoom bombing. Okay.
Oh, yeah.
So
Case of the Mondays.
All right. So, and that exam is due tomorrow. Okay. Okay. Can you please leave me alone for a bit? Go read your book. It's been long.
Herbie's got to hit the bricks.
Can you please stop the recording for a second, Bob?
Yeah. Someone remind me to turn it on. I failed to do.
I'll be quiet now.
That voice is full of baloney. Okay, hold on here. All right. So I want to get back into the modules.
I have a question while you're looking.
Yeah, go for it.
Cornelia had posted that we get extra credit for a survey, but I didn't see the survey.
That's in there somewhere. I'll make sure you're able to do that.
Okay.
Yeah, I think that's the class survey. It has questions like, are the facilities adequate? Ah, I know what I'll do. I know what I'm gonna do. Okay. Let me just take a peek at something for a moment or two. Could I ask you to write down a few things while I see what I'm doing here? You ready? You got a pen? Know your journal entries for bank reconciliation, right? And the cash over stuff. Do you remember that? Depositor. Journal entries. Okay. I
Okay,
just
have
need
that
a few more private minutes here. Looking at something that will help us.
Wait, Christine, did you say that did you get the email for the extra credit or you did not? Sorry, I missed that.
I never got an email. I could have, and then like thought it was junk and got rid of it or something, but I never saw
Yeah.
it.
No, I didn't either. And I looked through my email too, and I
Yeah.
didn't find it.
I
So
didn't see it. I looked through my junk. I went in the junk and nothing.
yeah.
Good. So it wasn't just me.
Yeah,
Doesn't sound like it. No, Patty? Okay.
no.
I saw one thing from just like digging. I saw like after it's like in the module attached to the test. So like after I was thinking maybe after we do the test, we do the survey.
Hmm. Yeah, I didn't get very far on that.
But she did say an invitation on the email, right? And that's why I didn't see that.
Okay. Zip, zip, zip. We're zipping the modern way here. Uh-huh. That's interesting.
I have one more question while we're waiting.
Go for it.
Okay, when I first retook chapter 7 quiz, I submitted it again, and so now it says late. Does that matter?
No, I'll take care of that.
Okay. I'm like, well, I just want to make sure. The rest of them, I just didn't even say it. I just looked at my old test to make sure. I was
Yeah.
doing it right.
Yeah. Okay. All right. Okay. Here's what we're going to do. We're going to work. Now I have a plan. Haven't run into this problem before with the scheduling. I better not work backwards like I was thinking. That confused a few people last time. All right. We're going to do bullets. Bullets, bullets. All right. Let me share my first screen. What I did was glance at the not the questions to the test, but an overview of what they've been doing in the past on some of these tests. I wanted to see how hard it was and if there's anything I want to emphasize, and there is. Slideshow. And here we go. We know what cash is and all about internal controls. We know how to open a bank account. The USA Patriot Act, we don't need to worry about that. Opening a checking account. All this you've already done. You all could teach this part of the chapter. The different types of endorsements, know them, right? So I'm just going to throw out bullets here and you can take notes as you think appropriate. Yeah, the endorsement. You just sign it yourself. It's a blank endorsement. Anybody can cash it if they find the check. Restrictive endorsements prevent people from doing anything with the check other than giving it back to you. ATM, writing checks. Know the difference between the drawer E, and payee. That one, I mean, that one comes up a lot. The bank statement and the bank reconciliation. There's always a couple of questions on the bank reconciliation. You're not going to have to prepare a bank reconciliation, but they're going to give you the information that would be used on a bank reconciliation and perhaps ask you to prepare the journal entries. In other words, you might have a journal entry for service fees. You know, you debit service fees and you credit cash. Keep in mind that all adjusting journal entries involved with the bank reconciliation will be a debit or a credit to cash, okay? You could have a bounce check. That one, you just reverse the sale. You debit AR and credit cash. Depositors books, bank books. Know the terms, deposits in transit, outstanding checks. Deposits in transit, those are checks that our customers wrote that are still on the way to the bank and we've recorded them. Outstanding checks are checks we wrote that are in transit on the way to the bank. And then you have all those ancillary charges from the bank. NSF, non-sufficient funds check, huh? And they're giving you some steps on the bank reconciliation. Just make sure you have this template in your brain. You start with, do the bank, I would say like they're doing here, do the bank statement first. In fact, you probably almost have to do that first, I think. Hold on. Bank statement plus deposits in transit, less outstanding checks, you're done. No journal entries on the bank side. The book side, you start with the general ledger balance and record all of the things you see on the bank statement that we have not recorded. I don't think this chapter's a tough one, to be honest with you. This one, you guys should really be acing. Your journal entries. Remember we had a 90% mistake, debit cash, credit accounts payable. This one was favorable to us. We found out the boss did some drawing. We didn't know this guy took $100 out with his ATM. Debit, drawing, credit, cash. Look at the bounce check entry. You're going to put it back into accounts receivable, right? We thought the guy paid us. So when we got the money, we debited cash and we credited accounts receivable. So now we're just reversing it back into accounts receivable. Miscellaneous expense, electronic bank. So anybody got any questions on the bank reconciliation? Anything doesn't make sense, or shall I continue? I will continue. Petty cash. Petty cash. Remember the journal entry to set it up. You have to debit petty cash and you have to credit cash. You're setting up petty cash. And then at the end of the month, you must, at all times, you must have $100 there. $100, even if it's in the form of cash and coins plus signed receipts. And that's pretty typical, that petty cash voucher, petty cash payment records, replenishing petty cash. Remember this, once you debit petty cash, you're not going to touch it again. All your journal entries after that are going to be to cash unless you're increasing or decreasing the balance of the petty cash. So don't make that mistake. It's a very easy mistake to say, oh, that well, we're replenishing the petty cash. I'm going to debit petty cash. No, petty cash amount was always going to be $200. And here they're in balance, $11.20 plus 188. What you do is you write you just record all the expenses from the receipts that you have there, okay? Cash short or over. Anyone who's ever run petty cash knows that'll be times where the end of the month comes and you're off a little bit. So cash short and over, that can be used for the petty cash account. And it's also used now for a change fund, which is a cash register. The cash register change fund also requires a debit just to set it up. So these simple journal entries could be on the test in some way. I'm not sure, but understand debit change fund, credit cash. When you look at your balance sheet, you're going to start with cash. Then the next line below that's going to be petty cash. Next line below that's going to be the change fund. Those are all your cash accounts. And again, here we go into our cash register, which normally has a fund of $200. $200. And at the end of this day of business, there was $1,450 in the till. We knew we had 200 to begin with, so our sales are going to be $1,250. That $1,250 represents the cash debit and the credit to sales. Cash short or over. You're going to be over, you're going to be short once in a while. Hopefully not too much, not too frequently. But what happens if we do get over? Well, the cash in the drawer at the end of the day was $11.61. And we had 200 to begin with. So the difference between those two represent the sales. Okay. That's the amount of cash. That's the cash change. We all agree, right? Went from 200 to 1161. So we know we're going to debit cash for the 961. We know we have a $2 shortage, which is going to be a debit to that account. And the cash register tape is always the sales number. We sold $963 worth of merchandise, but we can only count for 961. So someone walked out with an extra $2 in the change or something. Okay. Debit cash, debit or credit cash short or over. And then they're giving you an example where they're off by just $1 the other way. 200 in the change fund, cash in drawer. The difference has to be the sales, has to be the credit to sales. There's your debit to cash. There's your debit, or in this case, a credit to the overage. Credit to the overage. So I don't think that chapter was a buzzsaw. Anybody have anything they want to talk about or? Okay, so let me delete this one here. And now we'll go into chapter 9. Chapter 9. So give me a moment. Fastest way I can get to these is go through the module. Chapter 9, not chapter 9, chapter 10. My goodness, the semester's over, huh? Come on now. Here we go. We got that. We got that. Okay, I'm ready to share. Share. Be nice and share. Okay, well now chapter 10 has a little more guts in it, and you'll see this on the test. I mean, the test is 50 questions, and we have what? So how many chapters are we doing here? We're doing 7, 10 through 15. That's 5 because we're not doing 5. So we're doing 6 chapters. One second. You can see that, right, Patty? You guys, okay. That you can all see the slides. Okay. Cash and cash receipts. They might ask a little bit about the forms, the sales ticket. They might ask the difference of wholesaler or retailer. Retailer sells to you and me. Wholesaler sells to the retailer. They might have a question or two on some of the forms involved, the sales orders, purchase orders, etc. Nothing too deep there. Invoice. Credit memo. Credit memo is just a piece of paper that gives formal permission to a customer to send something back. Credit memo or a debit memo, depending what side of the transaction you are on. All right. Be familiar with all these again. I'm sure you are. Sales tax payable, liability, right? Not our money, but we got to turn it in. And know your contra accounts, the sales returns and allowances, the sales discounts. There'll be nothing on the refunds. I promise you that. The refunds accruing. Sales accounts. Well, we know how to write these journal entries, huh? We've been doing this forever now. When there's sales tax payable, we're going to collect more than the sale amount, right? When there's sales tax, when it's a sales taxable item, we're going to collect an amount beyond the sales amount. So we're going to debit cash for the full amount of the cash we received. We're going to credit sales for the extension of the merchandise times the price. And the credit goes to a liability, sales tax payable. And they're just showing you the same thing if it was done with accounts receivable. Know these contra accounts. What kind of an account are sales returns and allowances, sales discounts, credit card fees? They're contra revenue accounts. And you never debit sales. And I'm going to take 20 points off if I see somebody debiting sales on this, okay? Because some of the answers will say debit sales. Sales returns and let me see. Sales returns and allowances. That's pretty basic. So, but let's take a look at it. A customer returned an item for $46. Wilma Cutts was not happy with some product we sold her. She said, I'm going to return this to you. And we probably gave her a credit memo number or something. She said, okay, no problem. So she brings back an item that's $46. That's the sale amount, the sale. You never debit sales, you debit the contra sales returns and allowances. But we also have to pay her back the $2.30 worth of sales tax on this. We have to compute this $2.30, add it together, and that becomes the cash, or in this case, accounts receivable credit. Now, here's where we're not getting into the estimates of things. 210 net 30, let's understand that. 210 net 30, 2% discount if you pay in 10 days, otherwise you pay the net. 110 net 30, same thing. You could have 2% end of month, net 60. You can make up an endless cluster of them, okay? That's called a cash discount, a sales discount. Sales or cash discount is what that's called. It's not a trade discount. Remember what the trade discount was. That's just where you open up their catalog and it says everything on this page is 20% off. Well, if the item is selling for $100, you multiply that by 20% to get rid of that 20, and you don't put the trade discount into your financial statements. Remember, when you make the sale, you don't ever look at the a discount because you're not sure if the customer's even going to take a discount. We know how to write journal entries for sales. We know we debit accounts receivable, we credit sales and sales tax payable. I think we should be good there. I'm not going to go over posting to the general ledger anymore. We should be very adept at that now. We should understand that when you have accounts receivable, you are going to have a subsidiary ledger, which is going to look just like your general ledger. It's going to have a balance amount on the far right, and the debits and credits columns are for the detail. Okay. Relationships to remember. Well, the relationship is that the accounts receivable ledger, this ledger here for accounts receivable, in total, it better equal the amount on the ledger. Credit card sales, they threw credit card sales. They should have put this back in the chapter with the other contra accounts. So we're back to a contra account. Sale of $100 plus sales tax of $5. Okay. So that is going to be our debit to cash for 100. Debit for the bank fee of 420. And we're going to credit the sale for 100 and the sales tax payable 05. And they might present you with a question that just like this. They might give you all this information you see above with different numbers. And they might say, what is the credit to sales? And a lot of students are going to make a mistake and they're going to say $105. It's 100, not 105. What is the debit to AR? The debit to AR would have been 105 if there was not a credit card involved. But here, they might say, what's the debit to cash? And we know how to journalize cash receipts. Again, we know how to post them to the ledger. We know how to post them to the other ledger. End of the month, we run a schedule of accounts receivable. And in this case, it comes to $14,000 or so. And that exact number there has to be the exact number on the general ledger. Finding accounts receivable errors. That chapter takes a little more thinking. Any questions, any comments, anything you'd like me to go over? Just jump in. And let me delete this. Doing it this way makes it easier for me here. It's all about me. Here we go. Now I go into chapter 11. Chapter 11. Chapter 11 PowerPoint. Chapter 11 PowerPoint. Chapter 11. Chapter 11. Chapter 11 PowerPoint. That up. Letting my fingers do the walking there. That goes there. Come on, open up. Share. Chapter 11. Okay, we can see that now. There should be slides in front of you. Now we're doing the opposite of chapter 10. Sort of the opposite of chapter 10. The purchasing side. A little more complications in this chapter. A little more complications. Again, know what the forms are. The form that lets an employee ask for something is the requisition. Requisition. You know, you work for me, Nastasia, and you need a new computer for your desk. You say, hey, boss, here's a purchase requisition. Do you think I could get a new computer? And I sign off, okay. That will go to the purchasing department and they'll prepare the purchase order. They'll order it for us. The receiving report, when do we get it? And eventually we're gonna invoice somebody. Purchase requisition, purchase order. The purchase order is a contract. Receiving report, the invoice. Invoice, the seller calls it a sales invoice. The buyer calls it a purchase invoice. And the accounting department is going to have a copy of the requisition, the purchase order, and the receiving report, and the invoice. And you staple them all together. And then when you pay the bill, you're probably going to staple a copy of the check on top of that packet. I don't care how much computer power you have, you're going to have to keep these kinds of documents available. Cash discount. The buyer calls it a buyer calls it a purchase discount. Seller calls it a sales discount. They both can call it a cash discount, okay? Now here's the trade discount. Trade discount, you don't worry about it. Trade discount, that is a discount that's available to just about all their customers. So look at this invoice here. They're selling something. They're selling something for a total of $760. But look at this. They're giving everybody a 10% discount. So you're not going to be billed for $760. You're going to be billed for $684. That is your credit to accounts payable. We ignore the trade discount. The trade discount's a bunch of baloney. They charge you what they want to charge you. But psychologically, people like to think they're getting a deal. And that's kind of why they do that. Here are the contra purchases accounts. I haven't sung this song that much, but you never credit purchases. You never credit purchases. Never, never. You credit the returns and allowances, the discounts, okay? Freight in is an extra part of purchasing. Think of freight in as part of your purchases. That's basically what it is. The purchase account used to record the cost of the goods we're buying. The account is credited. The account, I'm so sorry. The account is debited. It's only debited. You never credit it. They're causing confusion by writing, oh, don't forget you close it, you credit it when you close. Well, yeah, we know that. But otherwise, you don't credit it, never. And here they're showing a simple purchase. You debit purchases. And I think you're starting to understand more and more now that we went through LIFO and FIFO. This company here, when they sell this product, they are not going to be putting in the cost of goods sold or the reduction in the inventory. Purchase returns and allowances, a contra cost account. Contra cost with the normal credit balance. Here we go. We returned something. We're going to eventually return something. We returned $200. Well, we don't have to pay $200 anymore, so we debit AP and we credit purchase returns and allowances. The seller is debiting, not accounts payable, but is debiting sales, returns and allowances. Oop, I almost caught myself debiting sales, and crediting accounts receivable. Assume the same merchandise, but the supplier. Here they just gave us a little break on the price. Purchase discount. You got the same thinking, 2% 10, net 30. 2% 10, net 30. We paid off a bill. We owed the company $100. We owed them $100. And we paid off only 98 because we get a $2 purchase discount. We paid within 10 days. Freight in is an adjunct purchase account used to record transportation charges on merchandise. The amount is debited for transportation purposes, and not going to talk about the closing. You might have one or two bullets on FOB on the test. Just understand the difference between FOB shipping point, FOB destination. You good with that, Nastasia? FOB shipping point, FOB destination? Nastasia, what happens at the point of FO? What happens at the FOB point? What has just happened?
Well, it's going to be shipped, so someone takes liability of the shipping package, either
Absolutely
the buyer
right.
or the seller.
Couldn't have said it any better. At the FOB shipping point, title is changed. If it was destination, title changes then, okay? And that's a very important consideration for a lot of companies. And you heard me babble stories that I used to use that to juggle cash. Freight, well, we got freight here, we're gonna debit purchases for 40, credit freight in for 38. If we get a separate bill for the freight, then we're just gonna debit freight in separately there. Gross profit. What is gross profit? Net sales minus cost of goods sold. They're giving us some information here. Net sales equals sales minus sales returns and allowances, sales discount. Cost of goods sold. You got to get the cost of goods available first. That's your history. Your beginning inventory plus purchases, that's what's available. And then when we get to what's available, we can figure out the cost of goods sold by subtracting the ending inventory. And that computes our cost of goods sold. We subtract that from net sales to get gross profit. And then in a couple chapters, we'll get into LIFO, FIFO, how we can take that 129,500 and turn it into different numbers depending on the method. Sad to say, you're not going to be asked to do the whole income statement as you probably would if you're in the classroom. But understand the relationships. Sales minus the contras, net sales minus cost of goods sold equals gross profit. What is the formula for cost of goods sold? Beginning inventory plus net purchases plus freight gives you the total available when added to the beginning inventory. So I think you're good with that. You should be having, if you did the homeworks and concentrated on LIFO, FIFO. And then again, we got where you had an accounts receivable ledger, you have an accounts payable ledger, simple purchases here, debiting purchase, credit accounts payable. I'm not going to go over posting to the ledgers. This should be second nature to us now. And we know at the end of the period, we're going to have to come up with a schedule of accounts payable. Was that enough on chapter 11, you think? Just let me know if there's something that doesn't make sense. I don't think this exam is going to be a buzzsaw. I don't think it will be. And the reason I say that is there's only so much time in a semester. Okay, hold on now, chapter 13. Doggies, 13. Poor chapter 12. We don't go near there. Chapter 13, come on. Chapter 13. Save. You should now be looking at the PowerPoints, correct? All right. I get some friendly raccoon waves there that we got this, okay? That's from the Honeymooners, Christine. You remember the raccoons at all with Jackie Gleason? The friendly
I do.
raccoon. Woo. If you're older, you know what we're talking about.
Yeah.
The raccoons, they were hilarious. They were so funny.
Yeah.
Come on now. I'm just gonna say one silly thing. For those of you who love the Honeymooners, at one of the raccoon meetings, Christine, they thought that they needed to go over the review of the requirements to become a raccoon. The requirements were 50 cents a month dues, progress toward an elementary education, and you have to live in the United States for the last 6 months. And Norton jumped up and said, "There's our problem. The requirements are too tough." Anyway, I like that joke.
I
You guys
remember.
don't understand it, but okay. Accounting for merchandise inventory. Okay, you remember this now, right? You must make a mistake in year 1. It has the opposite effect on year 2. If you understate the income in year 1, it affects it in year 2 the opposite way. You feel comfortable with this concept now? I think we should be. Been over this quite a bit. Yeah. Keep this in mind, though. Just remember, if you understate an asset, you understate the net income. So just keep that in mind, knowing if you overstate, it has the opposite effect. So you understate the net income, and that means that, of course, you overstate the expenses. You understate, you're understating your own assets here. And let's look at their example here. Here, they did it correctly. They had $20 in ending inventory, which was the correct number. So they brought the 20 over here to the next year, and everything naturally is correct. So we should be looking at net income of 30 and 30. But look what they actually did. They only counted 15. They understated an asset, so that understates the net income. And look what happened in the next year. It overstated the net income by the same amount. Why? Because we're stuck with this bad ending inventory. It has to become the beginning inventory of the next period. We caught this mistake way too late. Let's look at what they did. Also did. Another time, they didn't count 20, they counted 25. Counted 25 instead of 20. So they reported income that was $5 too high, and the next year it was $5 too low. And these can be serious mistakes. I mean, suppose they made a bigger mistake. Maybe it's a bigger company and they didn't count $50,000 worth of stuff. That might make the management think there's something wrong, and they start laying off people. So if you don't count the inventory right, you can get people fired if you really, screw it up, believe me. Let's understand the difference between the periodic and the perpetual. The perpetual, you know every second of every moment exactly how many units of inventory you have on hand, and you know what the cost of goods sold is on every unit up to that point of the month. The phone rings. Someone said, "I'm looking to buy 10 plasma TVs." The guy or gal at Costco just clicks in the part number you want, and then she says, "Yep, we have 20 left." You call the periodic person, unless the person knows off the top of their head, they have to go, "Hold on there, let me look." And while that person's looking, the customer gets impatient, hangs up, and buys it from the perpetual guy. Periodic, huh? Periodic merchandise inventory. Periodic, we debit purchases. Periodic purchases. you'll never see merchandise inventory. Perpetual, it's merchandise inventory. You'll never see purchases. Purchases are costs, expenses. Merchandise inventory is an asset. Know the difference in these journal entries. This is an important page in your book to review. We're pretty good with the periodic now. I think we can do all of these. Purchase merchandise on account, okay. Freight in, yep, that gets added to purchases. So we're going to debit freight in. We sold something for $80, all right. So we're good with these transactions. Over here, where you see the word purchases, you probably want to replace it with merchandise inventory. Merchandise inventory is an asset. So the freight also becomes merchandise inventory. Perpetual system, you have the 4-line journal entry. You have the 80/80 for the accounts receivable debit and credit to sales for the 80, but they're telling you the cost was 50. So immediately your system's going to debit an expense called cost of goods sold and credit your merchandise inventory. Purchase returns and allowances, that becomes merchandise inventory. Purchase discounts, that becomes merchandise inventory. So wherever you see the word purchases, change it to inventory when you're in the perpetual inventory system. Whenever you see the word purchases, that becomes merchandise inventory. Freight is an expense, just like these other items, that becomes merchandise inventory as well. Under a perpetual system, you might not have to take a complete physical count at month end. Your auditors may be very happy with what you've done during the year in terms of cycle counting, in terms of your internal controls. And they say, guess what? You don't have to spend the last week of the month counting inventory. You can go on your year-end break early. Consigned goods, that's the perfume, right? That's the perfume at Macy's, Nordstrom's. That's the smell of a consignment, is what that is. Consigned goods, it's owned by the shipper. Chanel sends a bunch of perfume to Nordstrom's and Chanel still owns it. The store doesn't own it until they sell it, which sounds contradictory, huh? Yeah, as soon as Nordstrom sells a bottle of perfume for perhaps $200, now they buy it from us for R125. FOB shipping point destination. Sounds like we're good with that. And now we've got the allocations of cost. Remember, an inventory item could be more than the cost of the item itself. Maybe you went out and you bought a big machine or something. No, let me change that. You went out and you bought a big, well, we'll say machine because that's your business. You sell machines. So you bought a couple of machines that you're going to sell. That goes into your merchandise inventory. So would the freight, and so might the insurance for getting that thing across the country, and any particular temporary storage fees. And then our different methods, specific ID, first in, first out. FIFO, 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 FIFO. Who feels we need to go into detail on LIFO, FIFO? Need a little more help, Nastasia? Pretty good with this, huh? FIFO, we sold first in. FIFO, we sold 200, so we sold the oldest one first, the 40. We sold the next purchase, that gets us up to 100. And we sold 80 from the second purchase. And we sold 20 from the third purchase. So we sold out all of the beginning inventory, the first purchase. And it looks like we even sold out the final, not the final, but the semi-final, the next to last purchase, leaving 50. All from the cost of goods available. LIFO, just the opposite. Last in, first out. LIFO, last in, 200. So we go to the last in. What was last in? 70. We know we sold 70 at 68, 80 times 57, 67, and we sold 50 at 65. That means that we still have that beginning inventory of 40 plus 10 left over from the first purchase of 60. Okay. Hopefully that's not too tough for the class. Weighted average. Whoa, we really like the weighted average method. That's an easy one, because what you do is you go to your cost of goods available, which is the same regardless of the method. You divide 16,500 by 250. That gives you a cost of $66 a unit. How many units did we sell? 200. How many do we have left? 50. Multiply it by 66, and you'll come up to 13,002 plus 33, 16,500. And then specific ID, they tell us where the goods were pulled from. Here is your original cost of goods available calculation. We have 4 tranches, 40, 60, 80, 70. Well, they're telling you 30 came from the beginning, 50 from the first, 60 and 60 from the second and third. So that's 30, 50, 60, 60. 30, 50, 60, 60. So take a look. 30, 50, 60, 60. They're telling you where it comes from. Multiply it out, you get cost of goods sold of 13,210 and an inventory of 3290. Please don't forget the shortcut that the total available minus cost of goods sold equals the ending inventory. Total goods available for sale less ending inventory equals cost of goods sold. Also, understand which method gives you the higher income, the lower income. Higher income, lower income. Here's the comparison of the methods. This is what we just looked at. FIFO gives you the lowest, I'm sorry, start again. FIFO gives you the highest net income. FIFO gives you the highest gross profit. LIFO minimizes your profit, minimizes your income. Weighted average amazingly comes somewhere between the two. And specific ID is a self-fulfilling prophecy. You're just pulling off from the layers exactly what was sold. So 4 inventory methods. You're not going to have to go through a whole calculation, but they are going to give you the cost of goods available, I bet, and say to you, all right, here's the calculation for the cost of goods available. Tell me what the ending inventory was at the end of the month. Tell me what the cost of goods sold was under different methods. The perpetual inventory, we know about, I'm not going to worry about that. And then I guess the last thing in this chapter, the conservatism principle. That's an accounting principle. This is a classic GAAP principle. Companies must always record anticipated losses and never anticipated gains. Land can go up in value. We never increase it on the ledger, okay? I mean, when you go to a bank, the banker might first look at your balance sheet and you say, geez, why should I loan you $1 million? You only have $100,000 worth of assets. And then you hand them the note and the valuation of the land. Yeah, but look at this asset that's understated like crazy. So we got lower of cost or market. Lower. We're looking for the lower. The lower, the better in terms of getting the answer. Lower cost or market. Cost means what it would cost to replace the goods now. Cost, let me say that. I didn't say that quite right. Cost is what we paid for it, okay? The market is what it would take to replace it right now. Right now. So the method assumes that a decline in the purchase price is accompanied by a decline in the selling price and thus signals a decline in the value of the inventory. And they're giving us a quick example here. The 3 items. One, they purchased for 8. The market went down to 7. So now we have a $7,000 inventory. We purchased something for 9. The market value at the end of the period was 10. Well, we go with the lower. Same thing here. Lower of cost or market. And there's a journal entry to do that. We go credit merchandise inventory. You'll never debit the merchandise inventory for a gain in value. You credit it and you debit the loss on write down of inventory. Okay. And that took us to the end of chapter 13. Shall I continue with 14? 14, I see 3 happy faces saying, go right to 14. Huh? $14. Ugh, why am I tired here? I'm not saying that my sister in the house that I own, that she lives in, is kind of off the beaten track. But my sister just bought my grandniece a pet, a goat, not a goat, a pig. Bought her a pig. There's a pig living in my house in back in New Jersey. Not sure I'm happy about that.
In your house?
I hope not in the house. Jeez. Yeah, she apparently grandniece goes out and takes the pig for a walk every now and then. Okay, let's see if I can. Oh, I got a little problem here. Okay, share, new share. Chapter 14. Oh yeah, the adjusting entries here, okay. I guarantee you're gonna get the out with the old, in with the new on the test. Out with the old, in with the new. Out with the old, in with the new. And we know our entries to record it. So here we go. Andy's Auto Parts had a beginning merchandise inventory of 25. And then at the end of the year, they counted it was 27 because they purchased more than they sold. That's okay. Merchandise inventory is not changed during the period. The merchandise bought during the year was debited to purchases. Now we have to adjust it at the end of the year. So what is the business with the out with the old, in with the new? Out with the old. On your worksheet, under the adjusting journal entry column, you debit merchandise inventory and you credit income summary. Part 2, in with the new, you debit the new inventory number and you credit income summary. So at that point, income summary has the difference of $4,000, which we're eventually transferring over. Steps 3, 5, okay, merchandise inventory. Yeah, this is exactly what we're not going to worry about. Not going to worry about estimating the returns. We don't estimate them. We just suffer them when they come in. Okay. Okay, so let's take a look at our worksheet. Here is out with the old 23, in with the new. You bring it over to the adjusted trial balance, the new 27,000. Okay. Look at your journal entries. Look at your 2 journal entries. Credit the old, out with the old. Debit income summary, in with the new, debit merchandise inventory. And now let's take a look at our income statement, huh? Sales minus sales allowances. And then we've got merchandise inventory, 23, that's out with the old. And we add the purchases to it and the freight, which is really part of purchases. And we subtract from that available number the ending inventory, whatever that might be. Unearned revenue, we'll talk about this again. Unearned revenue. When you receive money in advance of doing something, when you get money in advance for something you've not done yet, that becomes a liability on your part. It's a liability because you owe the service. You owe the service or the product. And again, season tickets to the opera, or in this case, a theater group. They have 1,000-seat theater. They put on 5 different performances a season, $10 a seat. So that's $50,000 if they got paid in advance. $50,000. They're going to debit cash, $50,000, and they're going to credit ticket revenue. In other words, they sold out all 5 performances, this nice local theater. Oh, hold on here. Jesus, what did I hit there? Okay, we're back in gear here. Adjustment for unearned revenue. They did 3 shows during the month. 3 shows. They were all sold out. 3,000 tickets, $10 a ticket. We debit the liability account. Unearned is a liability, and we credit the revenue, our regular sales. Okay. Chart of accounts. And they're taking us back to the worksheet. Let's go over these adjusting entries. There's really just a couple we want to talk about. The physical account. A physical account showed the merchandise inventory costing $45,600. That is the new. We have to do the good old out with the old and with the new trick. And that's up. And that's right here. Out with the old, out with the 52, in with the new 46. Oh, this thing doesn't, it's not let me. The other journal entries, we already know how to do. The unexpired insurance and supplies depreciation. Let's look now at Sunflower Cycle publishes a cycling magazine on the bottom, K. Subscribers pay in advance. Unearned revenue was $1,000. I think when we looked at this, that was actually the amount that they did provide. So let's take a look at it. Let's look at unearned revenue. Yeah. Okay. When they said the 1,000, they meant that was the balance at the end of the month. So they performed $2,000 worth of services. We debit unearned subscriptions revenue and probably credit something called subscriptions revenue. This is income. This is liability. And the spreadsheet, again, you're not going to have to do the spreadsheet, but one of the questions they like to ask, I don't know if they're going to do it on the final exam, but I think you saw it a little earlier, is they'll say, columns 5 and 6 show you what? The trial balance is the column 1. Column 1 and 2 is the trial balance. Columns 3 and 4 are the adjustments. 5 and 6 are the adjusted trial balance. So they might ask you what's in columns 5 and 6. If you have this in your skull, you shouldn't have any trouble with that. You know, you write it down on a piece of paper once the test begins, huh? And our adjusting journal entries. Under the perpetual inventory, we have similar adjusting entries. And here, and again, here they're showing the differences between the two methods. And we should be good on this. Wherever you see purchases, turn it into merchandise inventory. Purchases. Where's that word purchase? Becomes merchandise inventory. The year-end adjustments are what they just added to the above, which we reviewed earlier. In with the old, out with the new, and then we're not worried about the estimate of customer refunds and returns. Adjustments for sales, we don't do this. You could have shrinkage. Well, your records say you should have out there $3,840,000, huh? You counted the physical inventory. You counted the inventory over a period of 2 days, Monday and Tuesday. You then the accounting department and production, everybody worked late, maybe Wednesday, maybe even Thursday, trying to find why we have this $130 difference. Once we give up on being able to find it, we just have to eat it. We have to debit a cost called inventory shorter over credit merchandise inventory. So on this inventory, they were off 130. Who's got a calculator? Someone do me a favor, please, if you don't mind. What's 130 divided by 3840? 130.
0.0338.
0.0338. So they're off by about 3%. That seems like I don't know if that's a reasonable number now. 0.0338. So they're off by about 3%. Yeah, that's about right. Yeah, 1% would have been 38. Okay. That's actually kind of not good. And we're done with chapter 14. Questions on 14? Anything I can do for you? I really think you guys are going to do really well on this. We've been over this quite a lot. You've asked good questions. You've come to tutoring. What more can one do, huh? Chapter 15. What the heck was chapter 15 all about? Chapter 15. Chapter 15. PowerPoint. Okay, chapter 15 is on its way. Share screen. All right, Patty. Here we go.
All right, I see it.
Okay. Doesn't let me blow it up for some reason. Okay, here we got involved in the new income statements, and this is kind of tying together the last two chapters. We talk about different types of income statements. The single step, multi-step. Single step, maybe this is a good note to write down. Single step, cost of goods sold is an expense. Cost of goods sold is just a single line expense. On the multiple step, you got to show the calculation for the cost of goods sold, the whole thing. So a single step income statement just does this. It lists all the revenues on top. You notice it has all the revenues on top, no matter what type. No matter what type. And then it lists all of your expenses in chart of accounts order. Cost of goods sold is 244.4. So you come away with net income of 100,400. Single step, simple compared to the other one, right? Simple. The multiple step, you're going to start off with your gross sales. You're going to show all the debits to the contra sales accounts. That's going to get you to net income. And then you're going to have a heading called cost of goods sold. You're going to have a title called cost of goods sold. And then we got to go through our calculation. Our calculation. Selling expenses, we should know what they are. Anything to do with the sales department. Could be commissions, the things you see here, plus company cars, company offices they might have. Everything else is called general and administrative. I like to call it administrative activities. Everything else but selling expenses. So here's what we're talking about with the multiple step. We start with sales of 473. We subtract the allowances, net sales. We then go through the cost of goods sold, beginning inventory, plus the purchases, plus the freight, gives us what's total purchased, gives us total available. Total available, less ending inventory, cost of goods sold. Let me repeat that. Beginning inventory plus purchases gives you the available. You subtract what you still have from it, and that means that you sold 244,300. That's your gross profit. And now we have the operating expenses, which really should be broken down into two separate itemized columns, selling and admin. Doesn't do that, but that's okay. And we subtract it out, and we're going to call it income from operations. Income from operations. Operating income. That's what we want to call it, operating income. In addition to our operation, we have some non-operating things. We apparently loaned money to somebody, and they owe us interest. We rented out part of our store to somebody, and the rent is $7,500. And we've got a company flyer that we sell, subscription. These have nothing to do with operating a bicycle shop, ancillary to it. And also we have interest expense. We opened up the bank statement, and there it is, $1,600. Or we borrowed money and the interest is $1,600 a month. There is your net income. If we're good on on the calculation of cost of goods sold, beginning inventory plus purchases equal what's available minus the ending. There's our cost of goods sold. So this statement here tells people a little bit more than the other one does, okay? The best thing it does, it isolates the operating. If we were doing the single step here, you see where it says $800 for interest revenue? Let's make that 300,000. Well, that would make this company look great, but their sales are only really 475. It would skew the operation, at least the reporting. Multi-step. Good gosh, the statement of equity. I'm not going to insult you by going over it, right, Nastasia? We're an expert in this. Beginning equity plus net income minus withdrawals. That's all we're doing. Classified balance sheet. Okay, here we're getting into something called current assets. Current assets. You know, they're going to ask you on the test probably, what's a current asset? It's an asset we're going to use up within a year. If it's not a current asset, it's called a fixed asset. For now, let's call it property, plant, and equipment. Assets that are going to give us benefits for years and years to come. Current liabilities. Well, just like current assets, bills that are not due over a year. Any bill that's due, any payable less than a year due, okay? Long-term liabilities, you know, that's the opposite. Anything over a year is a long-term. And then the owner's equity. Okay, let's end by going over the ratios because this was the newest part, okay? I'm not going to talk so much about how to put the calculation together. I will to some extent, but what they mean, what we're trying to do. Some of your analysis is going to be looking at balance sheet stuff only. Others are going to be comparing balance sheet metrics with the income statement. Working capital, current assets minus current liabilities. Working capital. Working capital is the amount of money a company has left over if it paid off all of its current liabilities. All of its current liabilities. So this company has working capital of 93,100. Is that good? Well, you don't know until you compare it to companies of the same size. If they have a competitor who's much bigger, we'd rather show it this way. We'd rather show it in a ratio. The current ratio. Assets divided by liabilities. Current assets divided by current liabilities. This company happens to have a current ratio of 2.5 to 1. It has $2.50 for every dollar of debt. Another way to say it is if this company paid off all its debts, it would have still $1.50 for every dollar they paid off. So that $1.50 for every debt they paid off is the 34,800. And notice it says 35,800. Another little mistake. That should be the same number. Okay. Quick assets eliminate the inventory. Eliminates the inventory and the prepaids. Quick ratio. Quick. We just want all we want here is cash and receivables. Quick assets are cash and receivables. Nothing more liquid than those two. Here is your first statement analysis. Net income divided by the owner's equity. Well, you own a business that's worth on paper $460,400. You earned income of $100,000. This company is churning out 22% a year. So this looks like it's a pretty darn good company, huh? Yeah. In other words, for every dollar that this guy invested in this company, every dollar he invested in this company, he gets back 22 cents 22 cents every year. And you decide whether that's good or not. The accounts receivable turnover. This is the turnover where we take credit sales divided by the average AR and get a turnover. What is the turnover? It's defined as the number of times you sold the average inventory or the total number of times you collected cash. In this one here, accounts receivable, we're talking about cash. This company collected its average cash amount 9.6 times, but it's much, much clearer to turn it into days. How many days in a year? 365 divided by the turnover, 38.2. This company collects payments from its credit customers on average within 38 days. And that's pretty darn good. Okay? Credit sales divided by average AR gives you the turnover. Let's substitute inventory for accounts receivable, and let's substitute cost of goods sold for sales. And what are we, not for sales, for I'm getting mixed up there. Yeah, for sales. Okay. The inventory turnover. Inventory. Same thing. We're using the beginning inventory and the ending to get the average. Anyway, cost of goods sold divided by the average inventory gives us the turnover. And we're going to divide that into 365 to get 76 days. So on the test, there might be a question along the lines of compute the turnover, and you'll come up with 76 days. And then the next question could be a multiple choice saying, what does this 76 days mean? And the first answer could be, this is how fast they collect cash. This is how fast they pay their own bills. No, this is how fast it takes to get the product to market. From the time the product arrives in their store to the time they sell it takes 76 days. Closing entries. I think if we went over this, it would just confuse you. These are just closing entries. You're familiar with this already. They don't go into any real demonstrating detail here. And your post-closing trial balance has nothing but the balance sheet on it. Assets, liabilities, equity. And we'll stop at reversing entries. So what do you think? Was that helpful at all? Or maybe, hopefully, if it was not helpful, it gave you confidence that we can do it, right, Nastasia?
I think so. Thanks, Bob.
Can I give you all a poem of progress, a poem of encouragement? You like poetry? You ready? They said it couldn't be done. They said nobody could do it. But I tackled the job that couldn't be done. And do you know what? It couldn't. No, that's the wrong poem. I didn't mean to discourage anybody. You okay, Christine?
I am. That was funny.
That's a terrible poem. Patty, you okay?
Yeah, I'm good.
All right. Well, I'm going to be hawking your grades in a couple of days. So, and I guess we've got class on Wednesday, right?
Yeah.
And we're going to go over chapters 8 and 9. And you'll be able to get some extra credit for doing that by, doing the quiz, doing everything you need to do in the chapter. So don't neglect that, okay? All right. With that, I guess we'll call it a day. All right.
All right.
Thank
Sounds good.
you.
We'll see you
Thank
all
you.
Wednesday. Good luck on the test, guys.
Thank you.
Hey.
Y'all Wednesday. Have a good one.
Yep.
Bye-bye.